Okay, for this video, I wanted to discuss a common question I get, which is if I'm a dual citizen of the US and another country, when I'm asked to complete a withholding certificate, do I do the form W-9 or the W-8BEN, right, for foreign persons? It's a good question, and hopefully I'll lay out the very simple answer for you here on this one slide. Got the rules, some examples, and it should clarify everything for you. Now, the short answer, before we even get started, is it's the W-9. Right. What you're going to see here is that when you're a U.S. citizen, you're automatically a U.S. tax resident, no matter what you do. You basically have to relinquish your citizenship to get rid of that thing. So in that case, you're first and foremost always a U.S. tax resident because you're a citizen, and you're going to be completing the W-9. But let's look at some examples here and work through the rules just to support, our position here. So under U.S. federal tax rules, all U.S. residents are required to report their income and expenses on a tax return, so you're filing a Form 1040 no matter where you live and work, right? So this applies regardless of physical presence. So if you're a U.S. expat, so you grew up in the U.S. and you moved abroad, you're still filing tax returns. Or if you're a dual citizen and you've never even been to the U.S. So I have a lot of clients that were born outside the U.S., to a U.S. parent, right? And so they're automatically a U.S. citizen, and they might have never even been to the U.S. That does not matter. You're technically still a U.S. citizen, and you're a U.S. tax resident, right? So U.S. citizens are automatically U.S. tax residents under IRC Section 7701A30 Cap A. Okay, so again, your residency, your physical residency, does not change your tax residency if you're a U.S. citizen. So we have Frank here. He was born in Berlin. His father's U.S. and his mother is a German citizen. So at birth, Frank gets both, right? He's a U.S. citizen because of his father, even though he was born in Berlin. And his mother is a German citizen. He was born in Berlin, so he gets German citizenship. Now, Frank has lived his entire life in Germany, never been to the U.S. Under U.S. federal tax rules, he's a U.S. citizen. He's a U.S. tax resident, right? It's that simple. So if Frank is, let's say he turns 20 and he wants to open a U.S. brokerage account, and they ask him, hey, give us a withholding certificate and fill out all your residency information, all of that. When he's presented with which one do I complete, it's a W-9, right? W-8BENs are for foreign, non-U.S. persons. If Frank is living in Germany but he's a U.S. citizen, he is a U.S. tax resident, so he's completing Form W-9. He's providing his social security number, his contact address, which can be in Germany, right? It doesn't have to be a U.S. address, but his name, his SSN, and his address where he lives abroad. Okay. Now, if we segue a little bit away from the U.S. citizens, it's also important when we're talking about Form W-9 or W-8 to consider, even if you're not a U.S. person and you become a U.S. tax resident for one of these other two options, you might still need the W-9 also. So U.S. citizens or U.S. tax residents, you can also become a U.S. tax resident if you're either a U.S. green card holder or you're an individual who is physically present in the U.S. enough days to meet the substantial presence test, right, which is generally 183 days during the year. So if we look at this example here for Amy, you'll see how Amy can inadvertently create U.S. tax residency and might actually be required to fill out a W-9. So we have Amy. She's a citizen and resident of Denmark. She visits the U.S. on a tourist visa in 2020. And she spends 85 days in the country, okay? Now, remember, her most ESTAs allow you 90 days in the U.S. within a 180-day period, right? So she was in the U.S. for 85 and left, so she hasn't violated her ESTA. Now, in 2021, so the following year, Amy makes two separate trips to the U.S. Her first trip started in January 2021, lasted 80 days before she returned to Denmark. And then she came back to the U.S. On October 1st, 2021, and stayed for another 80, leaving in December. So Amy needs to look at how many days she spent in the U.S. and calculate whether she meets the substantial presence test. So for 2020, she won't meet it, right? Because the 85 days she spent in 2020 is not going to be sufficient. But for 2021, she will, right? And here's how the substantial presence test calculation can kind of trip people up. So to calculate the 183-day threshold, we use all the days she was present in the current period. So for 2021, it was 160. Remember, she was in the country for 80, left, then came back for another 80. So that's 160 in the current year. Then you take 1/3 of the days Amy was present in the preceding year. So 85 days in 2020 times a third is 28. So in total, she has 188 days that count towards 2021. So she exceeds that 183-day mark. So technically, if at the end of the year, let's say, so she left on December 20th, let's say she's in Denmark and it's December 23rd and she's opening a bank account in the US, and they say, hey, what's your tax residency? Provide me a withholding certificate. Technically speaking, she's a U.S. tax resident because she violated the substantial presence test. So she would be completing a W-9. She would need an I-10. She would have completed W-9, and she's going to be paying taxes in the United States as a U.S. tax resident for 2021, right? She's filing a 1040. Now, this is the extreme case, right? She's technically violated the rules, but in her case, I would try to argue that she has a closer connection to Denmark, so we could file a Form 8840, which is the closer connection exception. And that basically, what we say there is she has a closer connection to Denmark, so it overrides the computation of the substantial presence test. A lot of individuals do file this, particularly those that are in a relationship with someone that lives in the U.S. or their spouse, for example, is a U.S. citizen, because they do have the option and the ability to spend a significant amount of time in the U.S. because of their partner, but they don't want to trip over the substantial presence test. So Amy would file the 8840. That would be my advice to her, so she can get out of this U.S. tax residency for 2021. But very, very important to be very mindful of your days in the U.S. if you are not a U.S. person, because you can kind of trip over these rules. So that covers it for this slide. I hope that was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again on the next video. Thank you.